Hello. Just letting people in, slowly drip feeding in. Hello, Matt.
Good morning. How are you doing?
Good. Let's give it 1 or 2 minutes and then. I mean, you can feel free, Matt, to do the intro if you want. We're probably hi everyone. Hi. So welcome to the hedge call. You guys all know if you've been here before, this is where you get all your questions answered from the hedge course. Matt, here you are. Do you want to weigh in?
Yeah, no, great. Thanks. It's great to see everybody. Right now, we're excited that, again, everybody on this call has participated in some form of the hedge through the Spot Gamma Academy to learn more about how options work. So again, the hedge is a course which is focused on options. If you want to know more about what's happening kind of real time in trading ideas on a weekly basis, Imran does have his macro insights course through Options Insight. And if you want more of all the background analytics, you're not already a Spot Gamma subscriber, we have that through the Spot Gamma website. But today's call really is about answering your questions about how do options work and what things in the hedge could be more helpful to discuss directly with the instructors. Just so people also know, today we're going to be going live at 1 o'clock Eastern with Brent and Imran to discuss monthly options expiration. We put out at Spot Gamma, I think, a really interesting note showing a ton of options are expiring in terms of in the money, deep in the money calls, especially in individual names last week. So we put that out. That was picked up by a couple places, Zero Hedge, a few others in the last couple of days. So we've had Imran, actually more than 1,000 people come in new that want to know more about this from this information. So I was just working on that and coming in now. So I'm excited about Brent and Imran's call today at 1 o'clock Eastern, which is free and also available just through the Spot Gamma YouTube account and link. And so more hopefully helpful free content there, and we'll get into your questions.
Yeah, let's do it. And as we've done with some previous calls, let's try and get these simple questions out of the way first. So the more basic stuff, if you have got any basic questions, feel free to ask them ASAP, and then we can get on to the more complex stuff if there's things people want to get into. Great. Let's go. Let's hear them. Feel free to speak as well, right? You don't need to just put it on the chat. It'd be nice to actually see some of the people on the course. And
one of the things we purposely do is I don't put any gel in my hair in the morning for these calls, so everybody feels comfortable being on camera. So you can't look worse than this. So if anybody wants to come on, feel free.
Okay, can you elaborate on how to select strikes and expiries? Okay, is it better to buy out of the money because they're cheaper? Any advantages to buying at the money or in the money? Okay, that's a good question. Typically, is that you, Hollis? Is that you on the camera? That's Troy. Okay, no worries. All right, I don't know. I'm not seeing everyone up there. Sorry. So yeah, okay. So if you buy out of the money options, the main reason you're going out of the money, and the more out of the money you go, the more leverage you get. Okay. So if what you're looking for is you've got a directional view, you think it's going to transpire by the expiry that you choose, okay, and you want to get as much leverage as possible to your premium, then that's going to kind of make you go towards out of the money. The more out of the money you go, the more leverage you get because the cheaper it is. Obviously, the problem with that is the more out of the money you go, the less likelihood is you're going to get where you need to get to for that thing to explode in value, right? Because you're fighting against time, right? You go too far out of the money, you may never get anywhere near there where that option has the opportunity to explode in value. So it's a trade-off, right? It's a trade-off between the more out of the money you go, the lower that probability, but the more leverage. Okay, so you've got to find that balance which works for you. Okay, some people don't like going too far out of the money because, especially in the super short dated part of the curve. My personal preference would be, if I'm going 1 month or shorter, right, I don't want to go too out of the money, basically, because I'm fighting against time. Okay, the theta I'm paying is fighting against the money I'm going to make. All right, if I go 3 months out, then I might be more inclined to go far out the money and go, because the theta bleed on a 3 month option doesn't feel as heavy, right? You've got plenty of time to catch a nice move and get that leverage. But in a 1 month option or shorter, you need that move to happen fast. And if it doesn't happen, every day that goes by, you're fighting against the uphill battle with that option premium, basically. Yeah. So I would say, from my personal experiences, I think, you know, the more short dated it is, the more I'm looking for a closer to the money type strike, that I have confidence that if it starts to go my way, I get through strike, and that option is really going to deliver me some money because it's gone through strike. Yeah. The worst thing in the world is getting your view on an asset right. You pick too short dated an option and you only just get to strike by expiry, and the damn thing's worthless, or the same price that you paid for it and you made no money, basically. Right. So that's your risk when you're doing out the money stuff. Yeah. And in the money, really, I would never really do that. It's just, you got to get your head around the idea that in the money options are just the same as the same out of the money option, but with 100% delta against it, basically. Yeah. So that's all an in the money option is, right? So an in the money call, let me draw this one. So you got your at the money call, right? You got your 100 call, let's say, right? You've got your out the money call. I mean, you got your out the money call, which is here, let's say, is your 110 call. And then your in the money call, right? Which is your 90 call, right? That 90 call can be replicated by just buying the 90 put plus the underlying, right? The stock, right? If you, in 100% of the size of puts that you buy, okay? That 90 put plus stock is the same as that 90 call, basically. Yeah. So typically, because you tend to trade like the bid offer spread, the bid offer tends to be tighter for out of the monies. Yeah, you're probably going to be better off just sticking with your out of the money option. Okay. And trading, if you wanted the payoff of that 90 call, you would just buy the stock and buy the 90 puts with it, basically. Yeah. All right. That's hopefully that answers that question. What else you got? You got any more for me? Anyone? For calendar spreads, when the term structure is in contango, is it better to be long the short dated option and short the long dated because the vol is higher? Or is it the other way around because the shorter dated has higher time decay? Again, another good question. So again, the calendar, the curve being in contango, right? And let's pick some expiries like 1 month, 3 month, whatever, right? So there's your contango curve. Now, just because it's contango and this vol is cheaper, so the 1 month is the cheaper vol, doesn't mean that that doesn't make it a buy necessarily, right? Just because it's a cheaper vol, right? It's the cheaper vol for a reason, right? The market expectation of what's going to happen is lower in that 1 month time frame relative to that 3 month time frame that contains more potential movement, more uncertainty, whatever it is. Okay, so it really does depend. Yeah. If sometimes you get crazy steep curves, right? You get really, really steep curves. And to the point where this 3 month is rolling down such a steep curve relative to the 1 month that the theta that you're paying on the 1 month is actually being quite nicely compensated. You're paying theta there and you're earning theta on the 3 month. If there's a big roll down because it's so steep, you might be earning a decent amount of theta on that 3 month to make it worth doing that trade. Right? And you might want to be long gamma, you might want to be short Vega, right? When you buy the 1 month and you sell the 3 month, then you're long gamma, right? Because the 1 month contains the gamma or more gamma, let's say. They both contain gamma, but the 1 month contains more. And then the 3 month is going to have more Vega on it. So that might be the trade you want to set up where you're long gamma paying a little bit of decay, you're short Vega. So overall, if this whole curve shifts down like this, you know, that short Vega is going to actually make you money because the whole curve is shifting in vol. And so the idea is you might be bullish on a stock, the vol's collapsed, you want to own those calls in the 1 month, but you're worried that the vol's not going to perform or the vol's going to go down if we rally, then yeah, it might make sense to settle that 3 month against it to give you a Vega hedge, basically. So not only will it give you a Vega hedge, it will also give you a bit of theta back from the fact that you're short this option, this 3 month option. Yeah. But like me personally, like I'm quite a big fan of doing it the other way around when curves are a little bit flatter, where I buy the 3 month and I sell the 1 month. And I play that thing going back to contango because that's the higher probability outcome, right? Typically that front end doesn't sustain at flat and it collapses back down quite quickly, right? So it depends on what type of trade, but that's a carry trade, right? When you're getting into that trade, it's a carry trade, right? A carry trade, i.e. it's trying to be earning theta. You want to earn theta. That's one of your primary motivations to do the trade. Yeah. When you're doing this one, it's a bit like, okay, I want the gamma, I want the delta of this 1 month option, but I'm thinking I can use this more expensive Vega because it is very expensive. There's quite a steep curve. I can use that to give me some kind of a hedge against it, basically. Okay. That's the idea. Hope that kind of explains when and why you might do each way round of that calendar. Yeah. With a calendar, should you use the same strikes, say March 50 and June 50? What about the difference in price? Should you sell more than you buy with some kind of ratio? Yeah, again, it's a function of, you know, how much premium are you willing to put on the table? Are you willing to be a net buyer, a net spender of premium? Do you want to keep it zero cost? That's going to determine whether you sell more to ratio it and stuff like that. It's more risky in terms of if you're going to ratio it and sell more of the front, then you are going to obviously take on more gamma risk. But personally, yeah, I mean, Adam, I think you're talking about Bitcoin in particular there, right? Looking at March, June 50K. So, you know, the March, June 50K BTC calendar, call calendar, I guess. Call calendar. So that's the 50K, it depends what the delta is, but basically that thing's going to be a positive delta, right? Because the delta of March is going to be greater than the delta of June. Okay. So if you just did that 1-for-1, it would be a positive delta trade and you'd be paying premium. Okay. So if you wanted to neutralize that, not to be a long delta position because you're bullish, but you wanted it to be a vol trade, well, what would you do? You would have to sell more of these, right? You'd maybe multiply that by 1.5 or even 2, okay, which would neutralize the delta and would make you more short gamma, make you earn more theta, right? So, but you would basically check the delta of the options, right? Check what that delta is. If that's a 20 delta option and that one is a 40 delta option, then you're going to be delta neutral, you're going to have to sell 2 of these basically, right? If you sell 2 of these, you need to check how much Vega's on it, right? What's the Vega exposure? And then see how much Vega you're short in March, how much Vega you're long in June, And then obviously you're going to be short gamma, right? Short gamma, check how much short gamma you are. That will determine how, and then you have to figure out that for that short gamma, you're earning theta. How do you feel about the theta that you're earning for the short gamma that you have? Is that a trade-off you like because you think the market moves less than the number that will then lose you your theta, right? So there's a bunch of considerations here, but typically, you know, if you're doing it because you're doing it as a carry trade, as a curve trade, yeah, you're going to ratio it to get it closer to flat delta and closer to flat vega, basically, right? That's because then when that curve really does steepen, then you're confident you're going to make some money. The problem with not ratioing it makes you long too much delta and long too much vega, basically, right? It's not really a relative value trade because you're outright long a bit too much. Yeah. Right. Hopefully that answered your question, Adam. For the futures market, do you look at the futures curve or the implied vol options curve? What are your best practices around this? For example, gold futures curve maybe in contango, at the money vol not in contango. Is there any insight to gain from either? Thanks. Okay, yeah. No, I mean, I don't consider the futures curve telling me anything about volatility, right? The futures curve is being driven by things like interest rates, dividends, storage costs for gold, whatever the hell it is, right? That's completely independent of volatility, right? What the volatility term structure is telling me is about the market's expected volatility through different periods of time. That is independent to what the futures contango or backwardation is saying. That's completely different. Now, that's not to say that you can't take advantage of a futures curve that is beneficial, that kind of, you know, you can lean on the fact that the curve might be steep contango, so the longer dated forwards are trading really high, and you might be a call seller because you want to earn some premium, and you might sell longer dated calls to take advantage of that high forward, and because you're effectively getting a good entry point on your short, basically, right? But what you're doing there is you're combining an option that also gives you a delta view, and you are then using the shape of the futures curve to pick the delta expiry that kind of works well and takes advantage of the shape of that curve, if that makes sense. Yeah, it's quite a complex question and answer, but to your first question, the futures curve tells me nothing about the volatility. They are different things. Yeah. All right, great. How do you determine how much risk to use per position? Is that just Adam, is that just a broad question about everything? Or are we talking about a specific trade here? Because that's more about just general position sizing, right? So if you've got a defined risk, like it's a long premium trade, then you know how much, figure out how much of your portfolio you're willing to risk per trade. Either that's a fixed unit that you do on every trade, or it might be like some Kelly criterion sizing algo that you use to basically you use some subjective probabilities to figure out what your edge is in a trade, i.e. the payoff that it will make if you're right, the loss you will take if you're wrong, the probability of those outcomes, and that determines your edge, and then you use that edge to determine your sizing. That's called Kelly sizing or Kelly criterion sizing. There's videos on that available on YouTube and stuff. In fact, my friend Greg at Genesis Vol did one very recently talking about Kelly sizing, which is worth a watch. So if you're talking about just in general, those are the type of things people do. When trying to monetize put hedges, what metrics system do you use to close your puts without getting killed if your timing's wrong? Is swapping the delta exposure with the underlying a good idea to exclude the vol risk? Does this only work with in the money puts since out the money puts have no intrinsic value? Well, I mean, yeah, I wouldn't. The way I would say it is like the fact that you use an option to put the trade on as a hedge, right? if that put hedge then works, I don't think you want to exit it and then replace it with short futures or short stock, right? So I don't think you'd swap the delta with the underlying. I think what you need to think about is how much of a move are you anticipating? How much of a move are you anticipating in that you were trying to hedge out? Has that move materialized? If you got the move you anticipated, you had your hedge in place, it did its job, and now you're actually comfortable being long the asset again, then just bang out the whole hedge, right? Just sell it, okay, because it's done its job. If, however, you are still nervous and you have no idea where the bottom is in this thing, and you want to continue being hedged, but you also want to monetize something, then you might roll it. So you could roll strike. You roll the strike down. Okay, that's option one. Okay. Well, actually, option one is just sell it. Okay. Option two is roll strike down. Option three is sell a lower put, strike put. Right. And that is basically legging into a put spread, Right. So imagine you had the S&P, right? 47, S&P's at 4,700. Okay. We then dumped to 4,600 like we did today. Right. You've got the 46 puts on, right? You bought the 4,600 put because you're anticipating a sell-off. You could sell it. You could roll it down. What does roll it down mean? It means you sell the 4,600 put and you buy the 4,500 put. Okay. So what that would be rolling it down. Okay. You could keep the 4,600 put, but just sell the 4,500 put by itself. And that would be legging into a put spread, right? And what do you think the premium of the 4,500 put is going to be, right? It's going to be a lot higher than it was before the market sold off. So you're going to get some juice out of that put because the vol on that put is going to have spiked. That vol would have spiked on that 4,500 put. So you're taking advantage of that. You're keeping your 4,600 put that is short delta, okay? You're selling the 45 that is long delta, but a smaller amount of delta. So you're maintaining a bit of hedge. And if the market then bounces, what's going to happen to that 4,500 put? It's going to go back down pretty damn fast. And you can monetize it by buying it back. Buy back, okay? So you can do all sorts of things. Because if you had just rolled down to the 4,500 put and then the market rallies, problem is that 4,500 put now doesn't really give you any protection, right? Because now we're back up here and, you're only protected below 4,500, right? Which is quite far away. Whereas doing it this way is kind of cool because you're monetizing by selling this option that you weren't short before, but you can afford to sell because you've got a put in front of it. And then if the vol on that gets slammed and the market bounces, you're going to make some quick money buying that back. And then you're just back to your status quo, which was having your protection on basically, right? So I would maybe, depending on how much the vol has spiked. Yeah, if the vol spikes a lot, then I would favor selling the 45 put. If the vol hasn't spiked, then maybe I would favor rolling down. Yeah, but these are the type of considerations. These are the type of trades that you can do around that. Yeah. Hopefully that answers your question, Hollis. I know you suggested one trade we could do in negative gamma environments in S&P is to buy the vol trigger put and sell the put wall put. I would love to hear other suggestions for negative gamma. Okay, seems like butterflies do well in these high vol situations. Would love to hear your thoughts. Yeah, I mean, the thing about butterflies, though, is you don't really know where you're going to settle down, right? So, in negative gamma, we don't have this like pin where we know where there might be some support, right? So you got your put wall, right? And we're basically saying that we think that might be support, but because we know there might be a load of take profit happening there, which triggers a bounce. But the problem is we've got no idea where we're going to settle, right? We've got no idea where we're going to settle down. So when we're doing a condor structure or a fly structure, right, that we kind of want to know where this sweet spot needs to be, basically, right? And so what strikes do I pick? Well, generally, I want to pick strikes that the market is long, right? And the only time I have real confidence the market is long is on the call wall, basically, right? So I would say that, flies, if you just think vol is crazy high and you really want to sell it and you don't want to be, and you want to be covered with some wing protection, then yes, flies can make sense when we're in short gamma and vol's high and stuff like that. But for me, the conviction is much higher when we're approaching the long call wall, that we've got a reason why the market's going to stick there. And that gives me confidence as to how to pick my strikes, where I'm going to max out, where I'm going to put the fly strike or the condor strikes, because I'm going to be able to really leverage the positioning and make the money that I want to make via that carry trade. Yeah. I'm not sophisticated yet. I had, Friday got killed and dropped today, but thought it was high probability, so I did double my normal risk. 3-to-1 risk reward. Okay, sorry if I answered already. When trading a backwardated VIX term structure, are there advantages, disadvantages to using simple calendar spread versus diagonal spread? Mike, are you saying how does the VIX term structure trade compare to a vanilla options calendar spread or diagonal spread? Is that what we're comparing, or are you talking about VIX options? I'm going to decide which one to use as a hedge. So whilst you clarify a bit more about your question about the VIX term structure, I'm just going to answer Hollis. Put spreads versus riskies, how do I decide? Yeah, I mean, that's about how comfortable you are selling the calls, basically, right? So the risky, right? What are the main differences? So the put spread is cheap, right? Because you're selling the downside put. It sells skew, right? Sells skew, takes advantage of that. And it carries well, right? They tend to be your kind of plus points for a put spread, okay? The risk reversal sells calls, so you lose your upside, okay? So are you comfortable losing your upside? That's a big consideration, yeah? Where's the skew? Is the skew cheap? Because you're buying skew, right? So that's going to be a consideration. You're buying skew in the risk reversal. So when skew's super steep, that might not be a great entry for the risky. But it's got a high delta, right? High delta. So risky's got a high delta, which means what? The risky will be easy to monetize, right? So we like that. We like the fact that you can monetize something that's got a high delta. When you do a risk reversal, the market sells off, you can buy back the short calls, you can roll down the puts, you can leg into a put spread. There's lots of stuff you can do that is monetizing that move. With a put spread, unfortunately, not so easy to monetize, right? So it carries well, it gives you some protection, it takes advantage of the skew, it doesn't feel like it costs a lot and it gives you some leverage, right? But monetizing is a problem, okay? You need the market to stay down, go down and stay down. It's got to go down and then it's got to stay there, right? With a risk reversal, we go down, you can monetize it and then we can bounce. Here, put spreads, whilst they'll make a little bit of money on the way down, they'll only make the most amount of their money they can make if you go down and stay down, okay? So that's the big difference between put spread hedging and risk reversal hedging, okay? That's for Hollis. Sorry, I was brainstorming a plan using VIX or VIX options used to trade the volatility when the VIX is in backwardation. I was wondering if vol traders tend to use calendars or diagonals to do so. Yeah, so that's interesting. That's quite a sophisticated trade, Mike. So you obviously know what you're doing. So basically, VIX curve normally looks like this. This is for other people's benefit, right? VIX backwardation means this. So boom, boom. So that might be your 1 month. That might be your 2 month, right? Typically, you're going to focus on the first couple of months on the VIX when this happens. So the idea is that this happens when, you know, the old move might have been 18 and 20, and then we've gone backwardated. So this thing's at like 28 and this thing's at 26 or something like that, right? So let's stick some numbers, example numbers on it, right? So now one way to play vol going back down is to just sell the 1 month future at 28, right? That's the highest risk trade you can do. Okay, that's number one. Number two is sell the calendar, right? So you sell the 1 month at 28 and you buy the 2 month at 26, okay? Because we know that you're selling that at 2 vols over the difference between 28 and 26. If we go back down, it used to be 2 vols under, so you could potentially make, so okay, let's just say if 28 goes back to 18, you could make potentially 10 vols, which is obviously obscene amount of money, right? Which is a great, but that's why you're taking a lot of risk to do that. In this case, what could you make? Well, you could make maybe 4 vols, right? If we go back to status quo. But again, that's risky because this thing could keep inverting and it could like keep steepening against you, and God knows where it could go. It could go to -6, it can go to -10, who knows, okay? So it's still got risk attached to it. So the way you would mitigate that risk using VIX options is you would buy a 1 month put and sell maybe a 2 month put or something like that, okay? And again, effectively you're doing the calendar, you're doing the futures calendar trade, but you're doing it via optionality, right? And while, you know, that basically a much safer, much less risky trade, but, you know, it's obviously going to make less money as well, but it will still benefit from the vol collapsing back down and doing what you anticipate, basically. Yeah. So yes, we do, you know, your question was, vol traders use options on VIX to express this type of view, but also futures, depending on conviction, depending on the relative pricing of those options. There's a whole lot of stuff you need to look at basically for that. That's quite a complex structure though. Yeah. All right. Where can I find the $25 risky on spot gamma as mentioned on the course? Is the CBO skew index worth watching? I think the CBOE skew index is worth watching because it just gives you a broad measure of skew. Doesn't give you the $25 risky. It's a bit more convoluted in the way that it calculates skew. I think it uses more of the surface, okay? And the answer as to where you're going to find the risk reversal indicator, that I would refer over to Matt. Matt?
Hi, yeah, I'm here. Sorry, the risk reversal indicator. Was that from our, I have to look into the back of the metrics. Who asked that question? I did see that on there. That is.
That is.
Okay, Brent's here.
The risk reversal is in the daily note every morning. So if you just click in the daily note in the grid at the bottom, you'll see the 25 delta risk reversal.
Well, there you go.
And that links to a chart.
Cool. Okay. How to get in touch with actual tech support? Huh? There's someone asking about tech support.
Sorry, yeah, I see that. If you send an email to info@spotgamma.com, we aim to have any responses back within 24 to 48 hours. So just sending a straight email to info@spotgamma.com would be best.
Okay. How do I use different timeframes for realized vol? 30 days seems to be most common, but why use one over the other? Is this just looking for mean reversion or in implied vol, just like moving averages on price? You know, I think it's good to just have a few measures, right? So I would look at 10-day and 30-day. I wouldn't just look at 30-day. You know, 30-day doesn't really feel like it gives you a really good read on what's happening right now. Yeah. So if you want to really know what's happening in the last week or two, your 10 days a better measure. Yeah. Because that's the most reactive, right? The 10-day reacts faster, obviously, because there's less averaging going on, right? So your most reactive high frequency realized metric is going to be your 10-day. Some people even look at 5-day, but I think 5's a bit short. So 10-day is your higher frequency reacting quickly to kind of vol getting higher or vol compressing. So you'll start to pick that up. 30-day just gives you, I don't know, it gives you a measure. And because you're often trading 1 month options, you want to see what that spread is between 30-day and 1 month volatility to get a gauge of, you know, the relative cheapness or expensiveness of vol. But in terms of getting the current feel for the market, I think the 10-day is a lot more informative, basically. But I would use both. Yeah, I would monitor both, basically. Yeah. Is it better to set up multiple trades for an expiry, both up and down scenarios, knowing that only one will work? My directional trades at this point have not been working as well. Now, the problem with doing multiple trades for up and down scenarios is really you're just effectively trading vol, right? If you believe vol is where the edge is, then trade vol. If you believe your directional view is where the edge is, then trade the direction, right? So really, I could ask your question back to you in different words, which is, do you have any edge in calling volatility, or do you have edge in calling spot move? You're saying that your directional trades at this point have not been working, which suggests you're having a tough time calling the spot moves. So whatever you're using to decide which way the market goes, that needs some refinement and needs some work. But just jumping into trades and playing both directions, know that by neutralizing the delta and having trades that work both up and down just means you're trading vol. So if you're a buyer of options, you're buying vol. If you're a seller of options, you're selling vol. So your decision needs to be more around whether vol is cheap or expensive when you're doing a vol trade, basically. That is not got a lot of delta on it, basically, right? So then you need to figure out what metrics you want to look at to figure out what you think about vol, whether it's cheap, expensive, and then decide whether or not you have any edge in calling volatility, whether it's realized vol, implied vol, whatever it is, right? So that's really how I would break that question down. Yeah. Sachin, when will the hero indicator be available? Working for a bank, we're restricted in opening accounts at other places.
I can take this one. So the hero indicator for anybody on the call is our real-time indicator they're bringing forward in February. So we're excited to have that almost ready. It's been a lot of tech development. It takes in real-time feeds. And so what Spot Gamma provides to you is all the different levels where we see support, resistance, daily moves, things like the 25-day risk reversal that was asked earlier on the call. And then the hero indicator is meant to complement that for people that do more active intraday trading, to show the cumulative momentum going upward or downward across the options complex that's driving stocks and indices. And secondly, to show individual trades that spike. So in February, we'll be bringing that forward to the Spot Gamma community and doing a broader launch targeted for March 1st. So that will be very soon. Thanks for asking. Thanks.
All right, sweet. Any more? Does realized vol include the weekend? No, it doesn't. It's only, you calculate realized volatility based on a number of observations of the spot close, the closing spot level or something like that. Yeah. So no, the weekend, you don't have an extra 2 observations that are end of Saturday, end of Sunday. It doesn't work like that. Yeah, weekends are ignored in the calculation. It's business days. When you're calculating realized volatility, you are looking at business days. Yeah.
And the last question is on the hero indicator.
Yeah.
Okay, great. On the hero indicator, simply it'll have the same underpinning. So it'll be the same signal. It'll give the same overlay. Right now, Hero is available on Bookmap, but the Spot Gamma signal on our site will do the same thing. We have built out a couple additional features showing some trending levels across other indices, other areas, and some overlays, but we'll have all that available in a beta format starting in February.
Okie dokie. Is vol of vol a good lead indicator for future volatility? How do I read it effectively? In your opinion, what are the best leading indicators for market turns? Interesting. Yeah, I mean, personally, I'm not sure vol is a great indicator. Now, an indicator that I've, that I've been made aware of that I never really looked at much before is the ratio of the VIX and the VVIX. So rather than just looking at the VVIX itself, you basically look to see if the VIX is spiking more than the VVIX in relative to itself, basically. Okay. And what that tells you is, think about it this way, right? If you haven't got that strong conviction, this is probably the last question, isn't it, Matt? Yeah. If you haven't got that strong conviction of the market rolling over, you're going to be more inclined to buy VIX call options than you are going to be to buy VIX futures. Okay. Because VIX futures could just go down and kill you, right? VIX call options got a fixed premium spend, basically, right? And give you leverage to a crash, right? So in that world where your conviction of a sell-off isn't that high, or you're not so desperate for a hedge to de-risk your book, you'll see VVIX hold up quite well and VIX maybe drift back down, okay? If, however, you're starting to see the opposite, where VIX is out rallying VVIX, it's because people don't give a shit about buying upside calls on VIX. They want to buy VIX futures because they need to de-risk, yeah? And they've got way bigger concerns about the market that they don't need to faff about with VIX calls. They just need VIX futures on the book, basically, right? So I would argue that is a bit of a tell that something a bit more spooky might be about to happen when you see the VVIX-VIX ratio dropping, because the VIX is really starting to gather some steam relative to the VVIX, basically. Yeah, I think that is quite an interesting indicator, and it's definitely one that's been flagged to me by a quant who I respect quite a lot. Yeah. In fact, I'll tell you who it is. It's Darius Dale, basically, right, of 42 Macro. It's one of his indicators. You may or may not be aware of him. He's a very smart guy. And yeah, that's something that he monitors, and I can kind of see why he monitors that. Yeah. All right, I think that's all the questions, right?
Great. I think we covered a lot today.
We did. These were not basic questions at all.
I made a bunch of notes.
They were interesting.
I made a bunch of notes while you were talking.
Yeah, I was going to say, like, we could do a whole new module on some of these questions that people are asking. It's quite good. It's good stuff. And obviously, guys, if you like the answers, if you like this stuff and you want to get better, just have a look at this Macro Insight membership that you've got for a free month. Join the community. These are the type of discussions we're having on a regular basis. I do a macro call every week with a Q&A similar to this, but talking about actually what's going on in the market right now, how you're playing it, how you're thinking about it. So, that discussion continues in that if you're interested. Yeah.
And last plug for the free call today on YouTube. Also, there's Imran and Brent will be talking today at 1 o'clock Eastern. So again, through the YouTube channel, you can see them talking live today.
Cool.
Thank you, everyone.
Cheers, guys. See you in a bit. Bye.